I was meeting with a client that had restricted stock in a public company, and they were about to vest in some of their shares in a few weeks. And we were talking about exercise strategy. And I reminded them that whether you decide to sell those shares or not, you actually have to pay tax on the full value of those shares when they're vest. It doesn't work like option plans where you don't pay tax until you actually exercise the options and sell the securities. Restricted stock, as soon as it vests, it generates a tax event, which normally you see run through payroll, because how most companies work is they'll sell enough shares of the restricted stock award to satisfy your estimated tax liability, and then the rest of the shares are delivered to your taxable brokerage account for that company. But the risk is if you do not sell those shares, and let's say those shares all of a sudden take a significant loss, you now paid tax on the value of those shares only to have a loss when you eventually sold them later on.